Good morning, everybody. It is 7:04 on the West Coast, 10:04 on the East Coast. I got Ben Bry on the West Coast with me, kind of. He's down the hill in his red hat. And you've got Robert Marson, not here on the West Coast, so he's had a few more hours to look sharp versus us. So thank you guys for joining. We're going to kick it off with Ben. Ben and I just were talking about this trade and just put it on. So what do you got for folks? That's full disclosure that we just put it on, even though obviously when you hear the name, our trade's not going to move the name. So don't worry about it. We didn't front run you.
We are not going to move the name. Yeah, I think we're just going to fade some Apple here. You know, yesterday morning, I thought about buying Apple because I was like, when all this, so, you know, everyone knows what happened yesterday. And we were short some of the IPPs last week. I bought some puts in one of the accounts. And I was thinking that the CapEx recipients of this would get hit. They got hit pretty good. You know, everybody's been on Apple's case that they didn't do any CapEx and they just bought back their stock. And now now all of a sudden they're like, wait, maybe they know what they were doing. And so, you know, it's up 9% in 24, 30 hours. That seems a little stretched, you know? So I think what the thesis is going around, and it's all over there, is that now that LMs are going to be cheaper, they're going to be commoditized, and guess who's still going to own the distribution to the people? The rent seeker, the biggest company in the world, once again, after yesterday, the big dog Apple. And so, yeah, that might all happen. Apple hasn't grown units in 7 years. Apple's basically just a rent seeker. And so the argument would be that in a couple of years, there'll be a monster upgrade cycle. That could happen. That's fine. But it just, you know, it's at 10 times sales and it just ripped 9%. So this is more of just a trade. I'm not saying, man, Apple's the greatest short in the world. But I just think right here at 235, you could probably fade it a little bit. Because I also think the other dynamic going on is we all know that the pod shops are the marginal player in the market these days, and they have so much assets. Well, I'm pretty sure there was a lot of short Apple, long the rest of this stuff, and those boys are feeling some pain. And these things don't normally just cleanse in one day, you know? So I think there's some people excited about the thesis I just talked about. There's some, but I think the more is guys just getting out of their Apple shorts, and so then no one wants to give them supply. And, you know, I also just think the market in general is very lofty, given we just had one of the major drivers of this bull market just get kicked in the shin, if you will. And I know that, Jevons paradox and basically more compute, blah, blah, blah. The reality is that cheaper means cheaper. Yesterday was a deflationary event. The market traded in a way that was deflationary. Our staples, you know, like I pitched Budweiser on this show last week. That's up, you know, $4 in the last 10 days. And that's trading well. McDonald's is trading well. Pepsi had the first good day, and God who knows how long it's been for those guys. Staples are dramatically undervalued, or I don't know about undervalued, but out of favor.
No, maybe not. Yeah, just out of favor. Yeah.
Well, I mean, look, I know Robert and I talked about. I told him, I was like, I like Budweiser, EAB MBEV for everyone, ticker BUD, and he pushed back a little bit, but it's basically 13 times earnings, 8 times EBITDA. It's like 10, 11% free cash flow yield. I don't know, for an international iconic distributor of beverages, I think that's not bad. I think, yes, you could get cheaper, but I think that these things have had a really rough run. And I think that, Apple might be trading with that as well. Apple could be considered a staple right now. So some of this just could be a big staple. I mean, I think so. What do you guys think? Do you think Apple's kind of a staple?
It trades like a staple when the market goes down, doesn't it? It trades with a very defensive characteristic, which is why it's hard to make a lot of money short the stock. I do object to you calling them a rent seeker because they do innovate. I mean, last phone they put in a gram or a few grams of titanium, and they really are a revolutionary innovator there.
Okay, but let's get some stats though for those, because on Longbow I'm showing a trading range in the top of 236.97. So we're super close at that. and then the low end 216.06, so down 6%, call it, from here, right? And so when I'm looking at, like, it's short-term bearish, medium-term bearish, the short-term momentum indicators at 234 spot 15, medium-term 234 spot 49. So when we're looking at that, it's like, okay, you got pretty good odds for doing a short on this thing. And, yeah, it's like a potential short-term trade.
Yeah,
Don't go into
that's
earnings
exactly
like
what I was
this
saying.
unless
I just think
you have a fundamental reason. Yeah.
yeah, I think there's a bit of a squeeze going on. I think that there's people trying to build a narrative around it, as they always do. Price tends to lead narrative in markets. But yeah, look, this is at 218, 219, 220, in the pre-market yesterday morning, and now it's at 235. Like, Ian, I don't know. I mean, it just seems like, hey, that's a little overdone. They still aren't really growing. They still have some of the issues with China. Trump comes out last night and is talking about tariffs on semiconductors out of Taiwan. None of that sounds great for Apple, does it? You know what I mean? Like, so I don't know. I think it's a fade here. And then the other one that Robert and I, and this can lead into Robert, because I know he's going to talk about some of this, is I think you can buy a little ET here on this pullback. It was down 7% yesterday from ET's MLP pipeline. And yeah, I didn't realize that there was definitely some AI priced into that. But Chevron comes out this morning and says, "Hey, we're building gas-powered plants for data centers," and they aren't like, "Oh, we're going to cancel it because of DeepSeek." And I just think it'll have to be gas that does that. They're going to be moving gas because they're the biggest network. I don't know. I mean, the yield's still pretty good, relative to what you can get in the market. It's not as good as it was, but I don't know. Yeah. I'd buy a little ET here. What do you think, Robert?
I would buy the dip for sure. It's still my biggest position, so I'm not buying it. I haven't sold any stocks since I bought it, except once.
Okay.
I swapped some ET for EPD, and they're up about the same price. But both of those guys are going to benefit. And as far as electricity demand, even with DeepSeek, there's such an absurd backlog for power, and it's going to be unable to be realized, that if you slice it into fourths, I think you get a quarter of what people say we need. It would be solid growth. I think the gating factor is supply, and the CEO of hardware, and in the electricity generating business. So from gas generators to transmission to transformers, there's a huge backlog to grow at this 5, 6, 7% per year rate for electrons in the U.S., because we've grown 20 years at 0%, and the industry is just starting to ramp up their capacity. So there's going to be natural gas fueled unit growth for power demand, plus LNG growth for exports, that are going to keep this industry on a unit growth trajectory for 5 years or longer, even if the data centers get significantly more efficient on how they use electricity.
All right. So you got two people in support of ET, one talking about short Apple, and now you got Robert. Robert, what, I know you're going to be talking about some positions you talked about before. What are the things you've been doing?
Yes. So in the Marson Foundation, I did a couple of trims.
The Marson Empire. And the Marson Empire, what's going on?
I don't know about that, but thank you very much. I trimmed some TAT. It was an aerospace company, Israeli aerospace company. I bought in the $14 to $15 range. It got close to 30, 29 and change. And I did the old Marson trim special, where if you take a stock that's doubled or tripled, a lot of people like to sell half. I don't like to sell that much, because I like to let my winners run for years. And TAT has a phenomenal long-term growth story with MRO business for the fleet of Boeing 777s and the Airbus A320s. And they could grow 20% a year for 5 years easily on the top line. And those stocks don't come cheaply in today's stock market. But I took 20% of it and, took a double, got 40% of my cost out of the business. It was, around 80% trade. And, it's letting the other 3/4, 80% ride, because this trade has been totally de-risked. If I lose money in this trade, having taken out 40% of my capital, and I still have 80% of my stock, I got to be a complete knucklehead, right? So Did the same thing with Koru Medical, KRMD. Bought it at 235. It's 4 and change today, 410, 415. I'm starting to just trim that a little bit. It's up 75, 80% in 6 months. I hate paying short-term capital gains, but it's part of my process, my formal sell discipline. And again, that's about a 15%, 10 to 15% trim. It's liquidity is an issue there. I owned over a week's worth of trading volume, and I don't like to have a week's worth of trading volume in my long portfolio. So that's part of the reason there. I did take an extra large block in the summer when some knucklehead was selling it at 235. So I bought more than I wanted because I had an opportunity to establish a trading position at a good price in a thinly traded stock that I kind of thought, the next stop would be $4 in a year. And now we're getting there, but I'm not selling too much of it because it's going to be, most likely it'll be re-entered into the Russell 2000 at the, June. And the players in that game start looking for names in February, and they go long in February in anticipation thereof. And then they scalp their profits. And by May, they're already harvesting the gains as people front run these very illiquid stocks that need to be bought, shares purchased in the hundreds of thousands or millions to get into these benchmarks. So that should be a good stock there. And that's why I'm just trimming a very, very little bit. On the buy side, I added Silicon Motion, closer to 51, 52 the last 2 trading sessions. And, it's just a stock. It hit 85 last year. It's down sort of at a support level. It's tested 50 a couple times and not.
What do they do? I'm not familiar with that one. What do they do?
It's a semiconductor company based out of Taiwan that manufactures controllers for NAND flash. So storage and memory, both. They make them for storage chips and SSDs, solid state, hard storage hardware. So they have a great story. They have about a 4% dividend, $10 in cash, no debt. Had sold the company once for $113 to Max Linear, and Max Linear bailed. Thank God, because Max Linear probably would be bankrupt today had they taken the debt.
Right.
They have a core business that's levered to cell phones and PCs, which is not a great one. Although if this AI thing really is,
then anybody could be using that. That might be like the new. Everybody's going to be using it.
Yeah, I think Ben sent around yesterday a story about the edge now becoming much more viable as an AI play, along with the devices. So PCs and cell phones, if it's that much cheaper and that much better. So that would be great for these guys if there's a new cycle. But they do have an enterprise business that's starting to grow, and they have new products at much lower line widths than their competition. So they're producing now at 6 nanometer instead of 14 and 28, way ahead of their competitors. It's making their products be designed into the PC market and in a manner in which they've not been done before. So, with the new products in the core business and the new industry that they are generating a TAM for, which is enterprise controllers, center controllers, the stock's 12 times next year's earnings, 13 and a half times this year, 11 times next year, maybe. So there's a wide range on Wall Street's estimate, but it's down, it's cheap, it's growing. They had a growth hiccup. And, like I say with these stocks, if they put together good numbers in 2 or 3 quarters, the stock should reacquire its 52-week high.
Okay. And so when you say, what do you think people should expect? So you gave the time frame there. And is the max the 52-week high, or what are you playing for here?
Well, I think there's a report. I could get to $6 in 27. So 15, 16, 17p would be 100. So it in 2 years, it could double. It can go to par. I mean, as I said, it was sold for 113 a couple of years ago when stocks were a lot cheaper.
Right. All right. Well, you guys got some longs, some shorts on a day like today. Seems like a good way to create a little basket if you're interested in any of these, if you can play small caps, or if you want a massive large cap, where we put our mouth on that one. So I think that's it for today. Get into the seat because it's huge earnings season week. I don't know if you guys just saw something interesting. Maybe we'll end on one little discussion. U.S. consumer confidence dropping to 4-month low because of the job market. So taking a long time for people to get jobs, and obviously buying conditions for big ticket items like cars, houses, appliances softened. And if costs might be going up because of tariffs or, I don't know, levies or whatever you want to call it, on whether it's inputs or some of these things like autos from Canada or Mexico, the consumer might not be able to be spending as much. So that might obviously be good for our Apple short, but other things as well. I don't know what your guys' thoughts on that is.
Just think that egg prices are too high. That's like it's like the thing that is top of mind when you see getting egg prices.
Like if you can get them, if you around here, there's like a 1 carton limit.
My sister had a funny story on her show yesterday that my niece is 1.5 and was making eggs. She handed her 2 eggs. And then her husband's like, what are you doing? We can't even get eggs. That kid's going to break them for sure. So she swapped them out for hard-boiled eggs. Eggs are all people are talking about, and it's just like depressing when for the average person. And, then you think about really expensive stuff, and it just is like seems out of
whack.
Reach. Yeah, out of reach or whatever. And so with funding costs as much as they are, and I know Charlie Peabody's talked about it, things that need to be funded have been in trouble. Or think will continue to be in trouble. I think that just plays along with that theme.
Right.
I agree with you on the consumer sentiment and the job market and the downward pressure on inflation. And if you want to hear about the case for that from people much smarter than me, go to the Double Line, had a conference where they did a panel with a bunch of economists. And David Rosenberg is one of the deflationistas out there, and he's been for a decade. Wrong, but he makes a very good case along with a couple of other players that the consumer has turned down fairly significantly in long lead time intentions to travel and other things. So while the current data, the lagging data is fine, the leading data for consumption for these highly economically sensitive areas is negative. And then he talked about the rental market sort of being priced in to drop to negative or flat rents year on year versus owner's equivalent rent in the CPI, and that's going to bring it down again. And there was a third section on employment, and they're definitely talking about while the layoffs aren't high, the hiring is very skimpy in corporate America today. And apparently, companies are getting some benefits from, AI, and they're a heavy investment in productivity software and hardware. So they kind of believe the economy is set to downshift and inflation is set to materially downshift over the next 6 months. And they use that as a reason to be bearish, but I use that as a reason to be bullish, because the thing that was, in my opinion, at risk, I think there's a window where the economy could still be good, profits could still be solid, and inflation and the economic data could downshift, taking away that fear of the 5% plus 10-year. And the market would rally on that.
Interesting point there. Listen, that's it for us today. We gave you some good ideas again, long and short, talking a little bit about the consumer, which I'm sure we're going to be coming back to with Mackie, Berna, everybody. That's it for Wall Street Beats, and catch us back tomorrow. Thank you very much.
All right, guys. Got to run.
Have a good one.
All right.